But we start, as we frequently do at this time, with the morning brief. And just like us, corporate executives, they're just like us, I guess is the way we could say it. They're talking a lot about inflation, just like we're talking a lot about inflation, just like economists are talking a lot about inflation, just like real people who are paying higher prices are talking a lot about inflation. But the way that it's percolating through the market is quite different than perhaps individual consternation at paying higher prices. Miles, you looked at the sort of data that we're getting on individual mentions among corporate executives and then how that is playing out.
Yeah, so during first quarter earnings calls, this according to FactSet, we had 197 mentions of inflation from companies in the S&P 500. That is a record, and it rose at the fastest pace. It was that number of mentions, that 197, was up 138 from the prior quarter. So those were the calls covering the fourth quarter of 2020. That was also the largest increase on record. And no sector talked about inflation more than consumer staples. So the chart we see here are which factors consumer staples management cited as giving them inflationary or higher cost pressures, higher costs generated by category X. So 15 of the 26 consumer staples companies that talked about inflation mentioned higher freight prices as an impact. Higher ag was mentioned by 10 of those 26. And then, of course, labor costs were mentioned by 6 of those 26 names. All told, some 84% of companies that make up the consumer staples sector mentioned inflation on their call in some form or fashion. Now, the upshot here, as FactSet found, is that earnings estimates and also margin estimates, importantly, for the sector did increase during first quarter earnings season. They increased just a little bit, not a dramatic change. Margin estimates only went up to 6.8% from 6.7% prior to this earnings period. But ultimately, what we've seen in this data so far is that while inflation is a top of mind concern, inflation is something that is impacting how companies are thinking about their operations. They are mostly raising prices in response to that, and Wall Street analysts, in turn, are not downgrading their earnings expectations for these businesses. Now, over the longest of long runs, the only thing that matters for stock prices is how much companies are earning. An interesting dynamic in today's market is that investors are actually willing to pay less for those earnings. The multiple on the market has come down a little bit. I think that has to do with maybe the anticipation of higher rates and competition for equities versus fixed income, so on and so forth. We'll leave that for another time. But Sazi, I think it is instructive, again, to just take note at this point in the proceedings that expectations from analysts on how much companies can make this year have not come down because costs have gone up.
No, it's a very, very important point you mentioned, Miles, on estimates. And what I did find interesting, we just had Stuart Kaiser on from UBS, and he slipped in a line that he thinks estimates for the second quarter are too low. So if companies came out and raised prices aggressively, even despite inflation, we might be looking at a pretty surprising first quarter in terms of earnings beats that might resemble what we saw in the first quarter.
Yeah, I wanted to pull it up here but I don't have it right on me. But UBS, I believe, had $231 for their expectations for earnings. That might have been next year, but they were pretty aggressive. Keith Parker and the equity strategy team at UBS has been pretty aggressive in what they expect S&P 500 companies to earn. Morgan Stanley, they kind of did it a different way. Mike Wilson combined it like second half of this year, first half of next year. He was in the mid 210s, maybe around $220. But, Sazi, you slap a multiple of 19 on that, 20 on that, 22 on that. Now we're starting to look at the S&P at 20 times $200 of earnings is overvalued relative today. At 20 times $220 of earnings, that basically gets us to today's market. And then you throw that on, let's say $230 of earnings. Now you're looking at, S&P 46, S&P 4800, maybe S&P 5000. And so it all comes together in this weird soup of valuations just are not expanding right now. The multiple's not expanding on the market. And, to Stuart's point, Sazi, it feels like what we're getting is more revisions up in earnings estimates, but no one is getting more excited about it. And I think it's just a belief that rates have to go up if this inflation is not going to be transitory. And it really sets up for a fascinating battle, I think, for the markets later on this year and into next year. Just a completely different setup as we come out of recession than what we saw a decade ago. All right.